So the market's fairly intelligent, and if you actually look at what's gone on all year, it turns out that the United States stock market is within 6% or so of its all-time highs, not much of a drawdown. Developed markets, ex-US, are negative 14% already. And emerging markets are in a legitimate bear market, down 23%. So the market's not stupid. None of this is a shock. Stock prices have been discounting these differentiated global growth rates and corporate earnings pictures for the last 10 months. And I think it's perfectly warranted that we've seen the U.S. stock market be able to separate itself from these foreign markets. But the question is, what happens going forward and how much is already discounted? I don't think there's anyone out there calling for a global recession. And China probably does have to do some more of its famous intervention. But that's been going on throughout this entire post-crisis recovery period. It's not new.
Right.
And I think investors are savvy and they've picked up on this already.
Doesn't, Steve, it just reinforce, okay, we had volatility. Rates going up, we get it. Trade war, issues there, we get it. Maybe growth is going to slow a little bit. But if you look elsewhere, doesn't it scream, stay the course, stay sane, and continue to buy the U.S.?
I think it does speak to the U.S. If you take a look at what's happening in Europe, they've got inflation now. But if you move away from energy costs, they're still running at less than 1% in inflation, yet they're going to start tightening. I think the first actual rate increase is looked at in December 2019. You've got problems in Italy, as you point out. China, the problems are really severe. If you take a look at non-bank delinquencies, they've really moved up. The only reason we don't see bank delinquencies moving up higher, that's loan delinquencies, is because they're controlled by China and they're managed, definition of managed. So I think the U.S. is the best place to be, but I don't see being able to make a good return going forward next year. We've had 3 periods since 1928 when both an investment in 10-year bonds and U.S. equities were negative in the same year. I think we may have the 4th year of that next year, because everybody's already discounted the earnings, is my belief. When I say that, I mean the market's discounting the earnings growth. Now we're going to lap it, not see the same growth. We'll see growth.
Or maybe the market's gotten too
magnitude.
negative. Maybe people have gotten a little bit out of hand on the negativity.
I don't think so. We're only 6% off the highs, as Josh says. Some stocks are a lot lower.
Well,
than 6%.
that's a key point, I think, which is that if you look at a lot of stocks, there's a lot of stocks that are deep into bear market territory. It cuts across all industries, big, small, bellwethers. I mean, look, the Facebooks and Netflixes of the world are in bear market territory. What's been happening here, Steve, is a rolling bear market. I think it is tied, and Scott, we've brought this up before, the idea of peak earnings, perhaps precipitated by what's going on in China.